Welcome to today's video, where we cut through the noise and explain why simple, low-cost index funds tend to outperform most stock pickers over time. We will start by setting the stage with a high-level map of the journey, avoiding hype, prioritizing financial safety, selecting a brokerage, and building a simple, durable investing plan. With that overview in place, let's transition to an important disclaimer before we dive in. This content is for educational purposes only and should not be considered financial, legal, or tax advice. Everyone's circumstances and risk tolerances differ. Before making decisions, consult a qualified professional who understands your situation. With that said, let's move on to today's roadmap so you know exactly what we'll cover. Here's the roadmap for today. First, we'll discuss why consistency matters more than chasing the next hot stock. Then we'll cover your pre-investing checklist, including eliminating high-interest debt and building an emergency fund. Next, we'll compare leading brokerages. We'll then explain why simple index funds are usually the most reliable strategy. After that, we'll show a practical starter plan for $5,000 to $10,000. We'll examine the long-term impact of fees. And finally, we'll test your understanding with a couple of quick quizzes. Now, let's begin with why consistency wins. Consistency beats hype because markets are volatile in the short term but tend to rise over long periods. Automated contributions help you buy through various market conditions without the stress of timing the exact bottom or top. Starting with $5,000 to $10,000 is absolutely sufficient. The critical factor is setting a steady, repeatable habit. Ignore daily headlines because they are not a strategy. Over time, being invested and diversified tends to matter more than perfect timing. With that foundation set, let's move to the essential pre-investing checklist to make sure you're truly ready to invest. Before investing, address high-interest debt because its cost often exceeds expected market returns. Next, build an emergency fund covering 3 to 6 months of expenses in a liquid, safe account so a downturn does not force you to sell investments at a loss. Clarify your risk tolerance and time horizon to match your portfolio to your goals. Then, choose a brokerage among the major low-cost providers. Select a broad, low-cost index fund and set up automation and dividend reinvestment to keep your plan on track with minimal effort. Now that you know the prerequisites, let's visualize the decision flow to reinforce the sequence. This flowchart walks through the decision sequence. First, check for high-interest debt. If you have it, prioritize paying it off. Once that is handled, or if you did not have any, ensure you have an emergency fund covering 3 to 6 months of expenses. After that, select a brokerage, pick a broad, low-cost index fund, automate contributions, and plan to rebalance annually. The final step is to stay the course, which means resisting the urge to react to noise. With the decision flow clear, let's compare the major brokerages you might use. Vanguard is well known for pioneering low-cost index funds and maintaining some of the lowest expense ratios. The trade-off has often been a less polished user interface and fewer physical branches. Fidelity and Schwab, in contrast, tend to offer more refined digital experiences and wider branch networks, while still keeping fees extremely low and trades commission-free. Any of the three are excellent choices, so prioritize which interface and support experience you prefer. Next, let's break down the index funds themselves and how to assemble a simple portfolio. A simple, diversified portfolio can be built with just a few funds. For U.S. equity exposure, use a total market fund or an S&P 500 index fund. For global diversification, add an international index fund. For stability, include a broad bond index fund. The key is low cost and wide diversification. The pie chart shows an example of a long-term allocation with 60% U.S. stocks, 20% international stocks, and 20% bonds. Your exact mix should reflect your risk tolerance and time horizon. Now let's translate this into a practical starting plan for $5,000 to $10,000. To start with $5,000 to $10,000, open and fund your brokerage account. Then select 1 to 3 broad, low-cost index funds. Choose an allocation that fits your risk tolerance, such as 80% in stocks and 20% in bonds for a long time horizon. Set up automatic monthly contributions and enable dividend reinvestment. Rebalance annually to restore your target weights and otherwise avoid tinkering. Writing a simple investment policy helps you stick to your plan during volatile markets. Next, let's visualize how fees compound over time and why low costs are essential. This illustrative table shows the effect of fees on a one-time $10,000 investment over 30 years. At a 7% gross annual return, the low-cost option ends around $76,000, while a 1% higher fee effectively reduces returns to about 6%, finishing near $57,000. The difference of roughly $18,700 is due solely to fees. Over larger or ongoing contributions, the impact becomes even greater. With the fee impact in mind, let's check your understanding with a quick quiz. Question: before buying index funds, what is the top priority for new investors who have credit card debt and no emergency fund? Options: A. Start investing immediately to catch gains. B. Pay off high-interest debt and build a 3 to 6 month emergency fund. C. Open margin and buy more shares. D. Day trade to grow the emergency fund faster. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Paying off high-interest debt and building a 3 to 6 month emergency fund is the correct first step. This protects you from emergencies and reduces the likelihood of selling investments at a loss during market stress. Now that we have covered readiness, let's test your understanding of strategy selection. Question: which strategy typically offers the highest probability of long-term success for most investors? Options: A. Picking hot stocks in volatile sectors. B. Broad, low-cost index funds with steady contributions. C. Timing the market using news headlines. D. Concentrating 100% in a single speculative asset. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. A diversified, low-cost index approach with consistent contributions increases the probability of long-term success compared to stock picking, market timing, or concentrating in a single speculative asset. With the quizzes complete, let's consolidate the main takeaways. The key points are as follows. Prioritize safety by eliminating high-interest debt and establishing an emergency fund. Choose a reputable, low-cost brokerage. Use broad index funds, such as total market or S&P 500 funds, to capture market returns. Automate contributions, reinvest dividends, rebalance annually, and ignore short-term noise. Finally, keep fees as low as possible, because small differences add up significantly over time. To wrap up, let's summarize the journey and your next steps. In summary, consistency and patience beat hype and speculation. Start by eliminating high-interest debt and building a proper emergency fund. Choose a brokerage you find easy to use, such as Vanguard, Fidelity, or Schwab. Buy broad, low-cost index funds. Automate your contributions, reinvest dividends, and rebalance annually. With a clear plan and discipline, you put probabilities in your favor. Finally, let's close with a quick thank you and a call to action. Thank you for watching. If you found this valuable, please like the video, share it with someone who needs it, and subscribe for more. Tell us in the comments what step you are going to automate first and what topics you want next. See you in the next video.